James Athey of Aberdeen Standard Investments, Peter Schaffrik of RBC Capital Markets as well. Peter, the clear belief is that monetary authorities have run out of the tools in the toolbox. How bare is the central bank toolbox?
Well, I think we have to be very, very mindful of which geography we're talking about, because if you look at the ECB, it's probably much more empty than in other places. If you look like at the Bank of England, you have a couple of more basis points to cut, and maybe you can roll out another QE program. But whereas if you look at North America, be that the Fed or be that the Bank of Canada, they obviously have more space. So I think it's not as clear cut. And also when you look at other central banks, such as the RBA in Australia, for instance, who are on a mission to cut, have not done any QE yet and are talking about it. So I think there is clearly something that can be done. So I think that the real challenging point is those central banks that have done a lot already, who are very close to the bottom in interest rates, such as the ECB in particular, or some of the other Europeans. I think that's where the challenge is.
James Athey, if we assume that we have a global slowdown, clearly the headlines from the IMF and others indicates that is the forecast. And then when you mix in the dynamics of central banking, what does it actually mean for investment? Permanent low interest rates, and then what for the equity market?
Yeah. I mean, it's always dangerous to say things like permanent, Tom, because it tends to be the case that just when we think something can never be repeated or something will never go away is precisely the time that we enter a new paradigm. So for now, I agree with Peter. From an investment perspective, I agree with Peter in the sense that you need to seek out those geographies where there is more room to ease policy, because there is an obvious expression via sort of owning rates markets there. But to go back to the underlying economics of this all, to me, the Fed having 150 basis points, the Australians having the ability to buy bonds, the ECB buying equities, whatever. We're into the realms of the madness now. None of this is helping. This is actually making things much, much, much worse, because we're not dealing with any of the underlying problems which are causing this low growth environment. And in actual fact, I think we're well past the stage where we're contributing to this low growth environment via these ridiculously experimental monetary policy actions. So from an investment perspective, you want to own Treasury duration because the Fed has the ability to cut. It has to deal with some of these liquidity issues, and it's probably going to do that with more balance sheet expansion. All of that should be supportive for the rates markets for a good period of time. But you certainly, in my opinion, you certainly don't want to be owning risk markets, because they are still priced for a ridiculously positive outlook. And if you look at, for example, some of the BEA data that looks at corporate profitability in the US, and you compare that to the pro forma profitability that you see in S&P 500 companies, the two things are telling a different story again. And when that reality hits home, I think you're going to see equities coming off significantly.